Do you want to test your knowledge of the cash flow statement or your basic understanding of the cash flow statement? Well, here's a question that can help you do that. We have a question here. It's a true or false question. You just have to answer whether it's true or false, but be able to know why you've said true or false. So what I would want you to do is to pause the video, attempt all of them from number 1 to number 10, and then once you're done, you can press play and compare your answers to ours, and you see if you have done it correctly and how you have understood the cash flow statement by how you answer these questions. Okay, I hope you've done that. So let's go through them. 2.1, profit on the sale of a fixed asset is a cash outflow. Cash outflow means money that has left our premises. But firstly, what is the cash flow statement? The cash flow statement is a statement that records all the cash movements of the entity within a specific period of time. Okay, and this is usually within the financial period. And so if we have an opening balance of our bank account and a closing balance, the question is, how did we go from what we had at the beginning of the financial period and what we have now at the end of the financial period? Well, that's what the cash flow statement helps you to determine. Okay, so let's go through them. Profit on sale of a fixed asset is a cash outflow. True or false? Well, that is false. Okay, it's not a cash outflow. Why is that? Well, not merely because it's a profit, because even a loss on the sale of fixed asset would not be a cash outflow. Why is that? Well, because it's a non-cash item. Okay, it's not a cash item. When we say profit on the sale of a fixed asset, we're basically saying how much profit did I make for selling this fixed asset. Okay, and so you're not basically receiving money for making that profit, or you're not paying someone money for making that profit. Yes, you're making money by selling it and receiving the money, but the profit in itself is a non-cash item, and that's why it's an adjusting item. Okay, and that will go as an adjusting item next to depreciation, which is also a non-cash flow item. Okay, so let's keep going now. 2.2, if current year inventory is less than last year, this is a cash outflow. True or false? Well, I hope I answered 2.1. I said that it's false, of course. 2.2, if your current year inventory is less than last year, is this a cash outflow? No, it's not. Okay, and this is working capital management. Why is that? Well, if my inventory has dropped from last year, meaning I've sold more inventory. Okay, that's the rationale behind it. And so if I've sold more inventory, there is a cash inflow. Okay, if you look at the working capital management section of the cash flows from operating activities, that's what you should know. If my inventory went up, that would be a cash outflow. So the second one is also false. 2.3, if current year trade payables are lower than last year, this is a cash outflow. True or false? Well, what is trade payables? Well, trade payables is how much we owe our creditors, how much we owe those from whom we've bought on credit. And so if it's gone down from last year, of course, it's a good thing because it means that we've lowered what we owe our creditors. However, in terms of cash, it is a cash outflow, because if we've lowered how much we owe our creditors, it means we've actually paid them. That's how we've been able to lower it. And so if this year's one is lower, that means that it's a cash outflow. So 2.3 is true. 2.4, if current year trade receivables are higher than last year, this is a cash outflow. True or false? Well, what is trade receivables? Well, it's the opposite of 2.3. Okay, trade receivables is money that is owed to us by our customers to whom we sold on credit. And so if it's gone higher this year, it means we've not received more money this year. And so that is indeed a cash outflow in the cash flow statement. Why is it a cash outflow? Well, because remember, our cash flow statement tracks how much money came in versus how much money went out. Okay, it doesn't matter which section you're dealing with, whether it's a cash flows from operating activities, cash flows from financing activities, or cash flows from investing activities. But in this case here, since trade payables have gone up, since trade receivables have gone up, that means that our customers did not pay us, or more customers did not pay us. So we have to deduct that, because remember, that would have been captured in the sales. Okay, and that would help us come all the way to profit after tax. And so if it's already captured in the sales, we need to put it as a negative to show that we actually didn't receive this money. The difference between last year's trade receivables and this year's trade receivables is a cash outflow. Okay, that's also working capital management, by the way, as 2.4 is. And so the answer is true for 2.4, because if it's gone up, it's a cash outflow. 2.5, fixed assets purchased is a cash outflow. I don't have to explain that. That's obvious. That is true. Okay, whenever you buy fixed assets, that is a cash outflow. 2.6, a loan received by the business is a cash outflow. That is false. Okay, why is that? Because if I'm receiving a loan, that means I'm receiving money, and so that's a cash inflow, money coming in. Remember, the cash flow statement is not here to determine whether something is good or bad, or whether us receiving a loan is bad for the company because we are in more debt. That's not that question. The question is, did money come in? If it's yes, it's a cash inflow. If it's no, it's a cash outflow. Okay, so 2.5 is also true because we have purchased an asset. 2.6, a loan received. Oh, sorry, we're answering 2.6. Yes, loan received is a cash inflow. So 2.6 is false. Okay, it's not a cash outflow, it's a cash inflow. 2.7, depreciation is a cash outflow. I hope you were listening correctly when I mentioned on the profit on sale of fixed asset. Depreciation is a non-cash item. Remember, depreciation is the loss in value of my assets. Okay, that's all that it is, and that means that I'm not paying someone money for the depreciation, or no one is paying me money as depreciation. Okay, it's just the assets losing value, and so there's no movement of money. So that's false for 2.7. It's neither a cash outflow nor a cash inflow. 2.8, drawings is a cash inflow. That is false. What is drawings? Drawings is whatever is taken out of the business by the owners of the business. Okay, so they might take out cash, they might take out assets, and so whatever the case is, that is definitely not a cash inflow. If they've taken out cash, that would be a cash outflow. Okay, but in this case, it's false because they say it cash inflow. 2.9, interest paid is a special disclosable item. That is true. We disclose interest paid, otherwise known as finance cost, separately in our statements. Okay, as IFRS also dictates. And lastly, 2.10, an increase in investments is a cash outflow. Is that true or false? Well, that is true, because if I'm investing money in any endeavor, that means that it's a cash outflow. Money is leaving my premises. I hope that was helpful. I hope you've been able to highlight where you might be struggling, or see how well you understand the cash flow statement when you get to doing it, and you know where to put your positives and where you put your negatives. If you have indeed gained value from this lesson, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.